stop looking at the headline numbers because the global economic dashboard is lying to you. Everyone is obsessed with the $34 trillion debt bomb ticking in Washington, convinced that the United States is the reckless borrower and China is the prudent lender. That narrative is not just wrong, it is a dangerous oversimplification that could cost you your portfolio. We are not looking at a simple debtor-creditor relationship anymore. We are looking at two superpowers drowning in leverage, but they are drowning in completely different oceans. One is facing an inflationary firestorm, and the other is staring down a deflationary black hole. If you think you understand the global debt crisis, think again. This is not a recession warning, this is a structural breakdown of the sovereign debt model. Chapter 1. The Great Debt Illusion. Let's strip away the political rhetoric and look at the raw mechanics. The United States federal government is undeniably the most nominally indebted institution in human history. We are watching a scenario where interest payments on US debt have eclipsed the entire defense budget. This is a mathematical reality that screams insolvency. The deficit spending is widening, and the rate of accumulation is accelerating. However, the United States possesses the exorbitant privilege of printing the global reserve currency. This gives Washington a longer runway, a buffer zone that other nations simply do not have. But do not mistake this privilege for immunity. The bill is coming due, and it will be paid via currency debasement and inflation. Now, pivot to the east. The conventional wisdom suggests China is the flip side, the responsible saver with a debt-to-GDP ratio of only 84%. That number is a mirage. It is a carefully curated statistic designed to placate foreign investors and maintaining internal stability. When we deploy a forensic accounting approach to the Chinese economy, the reality is terrifying. Beijing does not have a debt problem, it has a solvency crisis masked as a liquidity issue. The official 84% figure ignores the shadow ledger. When we factor in the broader public sector, the real debt load is not 84%. It is conservatively 160%, and by some independent estimates, it shatters the 300% barrier. Chapter 2. The shadow ledger and the hidden iceberg. To understand why the data is so skewed, you have to understand the structural flaw in the Chinese fiscal system. In the US, debt is transparent. It is on the Treasury's balance sheet. In China, the debt is hidden in a labyrinth of local government financing vehicles, or LGFVs. This is the mechanism of the bubble. Provincial governments in China are mandated to hit GDP growth targets set by the central party, but they lack the tax revenue to fund the necessary infrastructure projects to generate that growth. So, they create off-balance sheet corporations, these LGFVs, to borrow money from state banks and build bridges, airports, and cities that often generate zero economic return. Conservative estimates place this hidden local debt at nearly $13 trillion. When you combine this with the massive leverage of state-owned enterprises, which function as hybrid corporate government entities, the total debt stack becomes unmanageable. We are talking about a total consolidated debt-to-GDP ratio that likely exceeds 300%. Furthermore, if we accept the research suggesting China's GDP is overstated by 20 to 60% due to compounded reporting errors, the leverage ratio could mathematically skyrocket to 450%. This is not just leverage, this is a Ponzi scheme operating at the sovereign level. Chapter 3. The Yield Paradox and Financial Repression. Here is the anomaly that confuses amateur investors. If China is so leveraged, why is the yield on their 10-year bond hovering around 1.7%, while the US 10-year Treasury is yielding nearly 3 times that amount? In a free market, riskier debt demands higher yield, but China is not a free market. This is financial repression in action. The Chinese banking system is a closed loop. Capital controls prevent money from fleeing the country. If you are a Chinese bank or a large institution, you cannot simply dump Chinese bonds to buy US treasuries. You are a captive audience. The People's Bank of China and the CCP control both the borrower and the lender. They can artificially suppress interest rates to keep the debt service manageable for these zombie companies. But this creates a toxic side effect. By crushing yields, they destroy the incentive for capital allocation. In the US, higher rates eventually attract capital. In China, low rates are a sign of economic sclerosis, proving that there is no demand for credit because the private sector is terrified to borrow. Chapter 4. The deflationary doom loop. This brings us to the most critical divergence between the two superpowers. The United States consumes too much, China consumes too little. The US economy is 70% consumption-based. China's is roughly 39%, which is astonishingly low for an economy of its size. This imbalance is the engine of the current crisis. China pumped its money supply, M2, by 16-fold over 2 decades. In the US, that kind of money printing triggered the inflation we are seeing today, but in China, it triggered an asset bubble in real estate, not consumer price inflation. Why? Because the average Chinese citizen is a super saver, terrified of a weak social safety net, so they poured every yuan into property. Real estate became the only viable savings vehicle, swelling to become the largest asset class on Earth. Now that the real estate bubble has popped, China is entering a balance sheet recession, a term coined to describe Japan's lost decades. Households are not spending, they are paying down debt. Companies are not investing, they are hoarding cash. This leads to deflation. Prices for goods are stagnant or falling because supply vastly outstrips demand. Deflation is the nightmare scenario for a highly indebted nation. In inflation, the real value of your debt decreases over time, which is the US strategy. In deflation, the real value of your debt rises, making it harder and harder to pay back. China is trapped in a liquidity trap where monetary policy becomes impotent. Chapter 5. The Asset Trap and the Solvency Showdown. Is there a silver lining for Beijing? Theoretically, yes. The argument is that while the US government has a net worth of negative $40 trillion, the Chinese government owns everything. They own the land, the banks, and the utilities. The Chinese Academy of Social Sciences claims the government has a positive net worth of $40 trillion. But here is the expert reality check. Liquidity determines survival, not net worth. You cannot pay bond coupons with a bridge in the middle of nowhere or a partially finished apartment complex in a ghost city. These assets are illiquid. If the CCP were to try and sell state assets to cover debt obligations, it would trigger a fire sale, collapsing asset prices further and accelerating the deflationary spiral. The US model is to monetize debt through the Fed and inflate it away, transferring wealth from savers to the government. The Chinese model is to internalize the debt, force state banks to roll over bad loans indefinitely and accept a long period of stagnation, zombifying the economy. Final chapter. The global deleveraging playbook. So, what is the actionable conclusion? We are witnessing the end of the Chimerica dynamic, where China saves and the US spends. Both nations are hitting the mathematical limits of their respective models. For the United States, the risk is currency devaluation and persistent inflation. The government will choose to sacrifice the dollar to save the bond market. For China, the risk is a Japanese-style lost decade but potentially more volatile due to the lower income levels of its population. You need to stop viewing these two as a winner-takes-all competition. It is a race to the bottom. The decoupling of these two economies means the US loses cheap goods, inflationary, and China loses its primary customer, deflationary. Your strategy must be to insulate yourself from both outcomes. Do not bet on the yuan displacing the dollar anytime soon. The liquidity just isn't there. But do not trust the purchasing power of the dollar long term. We are moving into an era of fiscal dominance where governments will confiscate wealth through inflation or financial repression. The safest assets will be those with no counterparty risk. The debt cycle is turning and the bill is finally due.